Thanks everyone for joining us. I'm excited to moderate a panel of market makers. We're going to answer a couple of questions here. Are market makers really necessary? We're pulling back the curtain on how market makers work, what makes them competitive, and why we should all be more transparent about using them. What the working relationships are, if they're predatory or not, and how to negotiate the KPIs you need and you want. Whether you're an exchange token or a project, you may need market makers more than you like or want, but how do you keep them honest and performing? Just a quick name and introduction here. So I'm joined by Julia Zhou, CCO of Caladan, Matt Mamigonian, head of sales at Flowdesk, Annabelle Huang, managing partner at Amber, Alex Taaffe, MD and head of U.S. business development at GSR, and Wesley Pryor, founder of Acheron Trading. Awesome. And then myself, Cumberland Labs research analyst. And we'll go ahead and just dive right into the questions. We've got a decent bit of questions. Maybe we'll try to get everyone to answer, but I feel like at the as we go through, it'll probably just be a couple people answering each question. We can start with you, Wes, and I guess we'll just go down the line. As markets start to look up, are market makers still necessary for every single token project? What about those with organic liquidity already?
Yeah, it's a great question, and the fact that we have to call this market making unveiled tells you that there's a problem in market making. But with regards to liquidity provision for highly traded assets, look at the fall of FTX and Alameda. Liquidity literally evaporated overnight, and we entered into the bear cycle, last bear cycle, and I think that's a really good case study to see where market making isn't just there for when the markets are hot. Market making is necessary throughout the cycle. So while there might be an increase in organic liquidity during a bull run, there's also coupled with an increase in demand. So market makers need to quote more depth to satisfy that influx in demand. And if liquidity does go through an existential crisis again, your market makers are really going to be the ones that are either able to withstand and continue quoting, or if they've mismanaged their risk, they're going to go bankrupt like last cycle.
I agree with a lot of what Wes said. I'll add an analogy that I like to, say to people when they ask about liquidity, which is if you have an iPhone and Apple's shares of equity are not trading efficiently, the iPhone still works well. If Ethereum is not trading efficiently, the protocol does not work well. So within crypto, liquidity is as important as ever, even if you have organic volume, for your protocol to function properly, for your users to have access, for your governance, and for the underlying core of what you're actually doing. So I think that's one analogy that helps sort of demonstrate why liquidity is important. But addressing the core question, which is if there's organic volume, why do I need a market maker? Well, it's because there's about 15 different exchanges that are centralized, that are decently high quality, and a plethora of on-chain sources, and there's no price continuity between these sources. You need someone who's there to maintain your spreads, your depth, and price continuity across those exchanges to guarantee for your users, your people that are investing, speculating, mom and pop, that they have a good trading experience, and that's key to the success of your protocol.
Hi guys. I really don't have too much to add beyond just those two, but I think, like the two of them said, market makers are designed to be the last resort.
I think as a final point, I'm not sure if everybody appreciates just how fragmented liquidity is in crypto compared to the traditional financial markets, right? There are hundreds of centralized exchanges. There's over 1,000 DEXs now, and that just doesn't exist in traditional finance, right? And we're only talking about on exchange. There's also private markets. There's also OTC, right? So I think that it is true that when markets are functioning perfectly, organically, and there's a ton of organic volume, and you're only on some very liquid venues, you might not need a market maker in that case. But as Warren Buffett says, when the tide goes out, you see who's swimming naked. And in crypto, the tide tends to go out a lot.
Awesome. Thank you. This is actually one of my favorite questions on this is let's talk about the contract terms in terms of the option loan model or the retainer. Is one or the other better for projects, specifically, decentralized exchange? Contract option or retainer model.
Yeah, so I would say, so first of all, Acheron operates under both, a DMM or retainer model and also loan and call option or principal market making structure. But I would say this isn't really a market maker question. This is a project question. I've got clients in the room that are working with us under a DMM capacity and PMM capacity. I think that's awesome. It's really, what's going to work best for the project. And that answer may change as the project goes through its life cycle. They may be willing to take more risk and have full exposure to the P&L of market making in a DMM structure for their launch. And then they may want to transition that to a principal model as they gain more outside liquidity. There's a more established fair value for the asset. They can negotiate more favorable terms and not risk, writing cheap call options. So, and the same can be said for already listed tokens that feel like their value might be undervalued. DMM is a great answer for those questions. So it's up to the project, I would say.
Yeah, so I think from the GSR side, I don't necessarily agree with everything that you said, but I do appreciate that there is a place for both, and it's very project dependent. When it comes to actually talking about efficient tradable volume and real liquidity that you can interact with as an investor, the loaded optionality model, it reigns supreme by far. And that's because of the option functionality in this model. In the, retainer-based model where you're, just trying to retain your monthly payment of 20 or 50K, as soon as you start losing money as a market maker, you're going to widen out your bids and asks. You're going to fall down for the project, when on the loan and optionality model, you actually are there to support the bid based on the option dynamics and the Greeks that take place. And, sorry for using option terminology here, and happy to kind of like dive into it in a little bit more detail, but specifically because of the way that the option dynamics are structured, as the price goes higher, because of the delta of the option, you can reduce the size of your loan. And as the price goes lower, you're then incentivized to buy. So the option-based market maker is distributing tokens on the way up and repurchasing tokens on the way down, which reduces volatility, incentivizes organic liquidity, and ultimately leads to a better trading experience for your users and better liquidity for the project. The other part of that is, one, those market makers who have loan optionality are bringing half of the order book. They're providing their own balance sheet. They have skin in the game. The other side of it, which again can be debated and non-regulatory, non-legal advice coming from the panel here, is from a regulation perspective, you want your market maker to be an arm's length agreement. You're not sharing profit. You're not having them operate through your own exchange account. So there's a couple different dynamics that come into play here. Again, I think there's certainly a place for both, but I feel strongly about the loan and optionality business. Happy to, take criticism or have a debate on that as well. I think it's, fun to chat about.
Yeah, I actually agree with what both of you said in terms that I think it largely depends on the project side, whether or not they're willing or they have enough treasury to provide the inventory to the loan or also pay for the monthly fees. A lot of times, the smaller startups, recently listed projects actually would prefer loan and option model because simple fact that they want better cash flow management on their side and don't want to have to overlay $10,000, $20,000 per month. But then there are also situations where the token projects will feel like their token are undervalued in the current market, so they don't want to give upside above a certain percentage, even though that can also be negotiated. An interesting perspective from the token projects regarding their treasury management is, I think some of them now is reviewing these loan plus option model in case that market makers actually do exercise the option. It is a way for them to raise additional funding at a premium to where their tokens are trading at spot. So a lot of times they don't even need to go out to do additional secondary OTC rounds anymore because their token has already been exercised by the market makers. So I think these are the few things that the token projects should consider when they're choosing between different models. And an important point is also that you have to consider what incentivizes the market makers. to your point, if it's a retainer model, then maybe, in the case that the liquidity evaporates in the market or the token's not trading well, then you're really just very passively putting the books on the market. And the KPIs within the market making mandates is not that easily strictly enforced almost. So we've actually had a lot of clients come to us after when they were working with other market makers on a retainer-based model that they realized that the book is wide, or they're not really, the market makers are not being active anymore, but they have no recourse to that. So I think it's important to consider what really incentivizes market makers to be with you along the way as well.
Yeah, so I think that there's a place for both models. I think the retainer side, if you operate in a more transparent way, what we would have the ability to do is provide more granularity on our performance. In the loan and call option model, which is great for a lot of projects, I think the lack of transparency that sometimes market makers provide, so I think that's another talking point. The second thing I would say is there's a lot more flexibility in what we will be able to do, or what a retainer model will be able to do, because you can kind of control the offering to suit the client and the project. The other thing I would say is, smaller token projects, while they may not be able to give up a lot of inventory to kind of suit the needs of what an option might need, it would take too much of the inventory. So that's also something else to consider.
I was speaking with a founder in the other room, the networking room, maybe about half an hour ago. And he was talking about how, he was considering between the loan and option model and the retainer model. And he said, I'm very wary of the loan and option model. And I said, oh, that's interesting. What makes you wary of this model? And he said, well, I'm worried that the market maker is just going to dump all of our tokens at the end of the contract. And so I sort of explained to him, that's not really how the loan and option model works. But I do think it's a common misconception, because this is something that I've heard from multiple people before. So sort of as Alex alluded to from GSR, right? From the market maker side, when you have an option on a loan, we're not just holding that option and doing nothing with it, and then, perhaps exercising it and then selling all the tokens at the end of the contract. That's not how it works. We are hedging that option throughout the life of the contract, which inherently generates organic liquidity and adds more depth onto the books over the life of the entire contract. So that's something that I sort of shared with this founder, and, I wanted to share with all of you.
Awesome. Yeah, that makes a lot of sense. And just a side note as well, you can always have multiple market makers. So maybe if you've got the loan and call option with one across certain exchanges and you want more depth and liquidity across others, you can have the retainer model with another. We'll go ahead and start it down that way this time for this question. That way we can get some more answers. What happens to liquidity during a crisis? How do different players react to it? What happens for token projects? What happens on the DEX? What happens on a centralized exchange?
Yeah. So as I alluded to earlier, in crypto, there's a lot of crises to refer to. So we can look back at what happened, just over a year ago, right? During FTX, for example. What happened during the crisis was that you saw a flight to safety. People pulled off of exchanges that they felt were, less safe for whatever reason. You saw a lot of concentration of volume in relatively fewer venues. From our perspective as a market maker, we reached out to all of the token projects that we were working with, and we sort of had a conversation with them about, what would you like us to do? Do you want us to continue market making on these exchanges that you're on? Do you want us to stop and pull your inventory off, right? And, perhaps give it back to you. So we had a very open dialogue, and I think that was very well received. And then I think in the following months, after markets sort of calmed down after the FTX crisis, you saw liquidity sort of returning, right, and flowing back into the ecosystem.
Yeah, I would agree with that. There's usually a flight to safety in these sort of situations. So that was the first thing. The second thing is, as a market maker, we try to be there to support. Obviously, we have to talk with the projects if they're comfortable, if they're willing. And then also, custody and making sure that we pull balances off so that, there's as much risk mitigation as possible. I would also say, too, you did see a flight to decentralized exchanges, too. So sometimes we would maybe direct our flow towards DEXs because there's a pretty strong pickup in activity on those venues, too.
Yeah, so I would add that outside of maybe what specifically that happened to FTX was just more, I guess, exchange counterparty risk concern, which would obviously have to help our market making clients navigate that as well. And even after that, I think the token projects are very conscious of where they list their token because it is your own inventory at risk a lot of times. But I think just during maybe normal kind of flash crash, market crash that we've seen over the years, or even sort of extreme market price movements, volatility that we've seen even today, I think it is very important for market makers to step in and to manage the price discovery, the price continuance, especially in a flash crash. Like I said earlier, we are here as the last resort. We have to put up this side liquidity, even though it looks scary out there. That's exactly what we're here for. And I think a lot of projects didn't understand the importance of that until it had already happened to them, which is already too late.
Yeah, a lot of good points. I think something that takes like a slightly tangential angle to market making is treasury management, foundation management, and I think it's important as you think about your token project as a business to properly diversify your assets, particularly as markets are doing well and things are working. If you have 98% of your treasury and your project assets sitting in your native token, and some of those tokens are unlocked, we would highly recommend that you start to diversify that, take some in cash, yield-bearing instruments. You can sell call options. You can diversify to Bitcoin and ETH. So, definitely keep in mind like treasury management ahead of crises. I think, in 2021, we were pitching a lot of treasuries to diversify and sell tokens, and not a lot of them did it. And this time around, we're doing it now, and a lot of them are way more receptive. So, I think that's definitely important to remember. And then particularly from the market making side, and, I think everyone here checks the box, but when you're working with a market maker, it's also important to understand the risk you're taking by giving them your tokens, because there's counterparty risk in that scenario, and making sure that you have someone on the other side who has a strong balance sheet, who has proper risk management controls. In a crisis, you don't want your market maker to go out of business and repossess your tokens and not send them back. Again, not to shill GSR, but there was after FTX, we actually compensated all of our customers that had tokens lost on FTX by repurchasing their full loan and not sending off any receivables to any of our clients.
Yeah, just to piggyback off the kind of, what happens in a crisis, I would say, Alex touched on the retainer model as being something that isn't really resilient. And I think retainer model is kind of a broad categorization of service provider. Retainer model could mean, you downloaded the Hummingbot command line interface and you charge, a client, $5,000 a month to run it for them. Retainer model could also mean that you have, a full custodial, totally segregated, white glove service. And, what we saw last crisis is a lot of the, principal market making desks that didn't manage their balance sheet appropriately, didn't manage their risk. They went down very quickly. And if you have exposure, to something like Terra Luna, that can impact, and that goes down, that can impact every single one of your clients. You don't have the ability to service those liabilities anymore because of one massive mistake. And one of the benefits I'd say of the retainer model is that if it's structured properly, each and every client has their own exposure. So if one asset, goes down, none of the other assets are impacted whatsoever. So that's just something that I would highlight in a crisis. And during the last cycle, we did see that, our contribution to, order book depth went up significantly in our retainer model clients. So
makes sense. Is it just about terms? How do projects pick the best market makers for them? I think this is the appropriate time to chill yourselves.
Right. So some of the questions that I would encourage a project to ask market makers are, I would ask about their infrastructure, and I would ask about their trading history with their own capital. So to chill a little bit, we have been trading since 2017 with our own capital, and, knock on wood, we've never had a losing day in all that time. I would also encourage projects to ask for references. I think probably one of the best ways to find market makers is to either get a referral from, one of the VCs on your cap table that you have a good relationship with, or other founders, right? I would ask them about their experience working with this market maker. How responsive are they? Are they sending you regular reports and updates? Are they actually meeting the KPIs that they agreed to you? So those are some of the things I would recommend to look at.
Yeah, I would say definitely references, the level of transparency, what they could provide, client service experience, how available they are to you, in conjunction if they're registered with any governmental organization or any regulatory agency, but also obviously the reference check too.
And then I guess in terms of the terms for the market making contract, especially around loan and options, that can get a bit confusing because there's so many different variables and parameters within it. And there's the common sort of KPI that all market makers have to meet, the order book depth, uptime across all the venues that you're on. But I would say, at least, for all the panelists on this panel, that we likely offer very similar terms in that regard. And the only thing that could be different is maybe where you would, how much loan size you'd be asking for, or versus the strikes of the embedded option that you're willing to price. But outside of these economic terms, which are all negotiable, and then different desks might have different risk preferences, as long as you are sure that you're comfortable with the counterparty risk and working with the specific market maker or market makers. The other thing I would consider is maybe just, the relationship that you do have. And I think each of us here have slightly different style, I would say, and different coverage in terms of geography. So a lot of times our clients would like that, I want to have instant response whenever, I speak to the desk. And so it depends on maybe you're in Asia or US. I think most of us are 24/7, or, if the clients prefer to have in-person meeting all the time. So there is a little bit of that geographical differences or focus, the relationship you're able to build, or the teams that you think that can actually work with you longer term. So from Amber's perspective, we've been doing market makers since 2018. Before that, we're also prop. And afterwards, we also branch into a lot of more client-facing services, so OTC, asset management, wealth management, treasury management, etc. So I would say our approach to market-making clients is not just focusing on market-making itself, but also the overall opportunities that we can work with them on. So yeah, it really depends on what the token project is really looking for, and that might kind of change their mind about who they want to work with. And now we're seeing that actually a lot of the token projects, especially bigger ones, tend to work with multiple. So I'm sure we've all been co-MMs on a lot of deals over the years. So you can really actually have, each pick that works the best for you.
Awesome. Yeah, I think the other panelists have covered, all the key parts. I think, Annabelle really knocked out a lot of the, items that matter, I think, in the long run, which is partnership, right? I think when you're looking at a market maker, you're not just looking at numbers on the screen. You actually want to understand what they're doing it, how they're doing it, who's on the other side of it. And in this day and age, there's a lot of consultants, there's a lot of middlemen and intermediaries. And I think, the way that those people pitch themselves is the ones that control the market makers. They keep them in check. But really, the business has changed a lot over the last 3 to 4 years. And, everyone's saying how long they've been in the business. GSR has been market making since 2013. We're the first market maker for Ripple. So we've been doing this a long time, and we've seen every model, we've seen every iteration. But I think like the resounding sort of, thing that we hear from our clients that really matters long term is like the partnership, what we can really offer. And I think kind of like the angles that we have and the experience that we bring is actually taking market making and the whole process and making really a much more of a consulting advisory service that's looped into market making. So, which exchanges should you be launching on? What fees should you be paying? Can we make introductions to those exchanges? Can we help you strategize with your go-to-market? If you're doing a fundraise, can we introduce you to our VC community? If you need marketing, if you need legal help, we have the full network, the full ecosystem partnership to be able to help ensure that your project is successful. And the market making agreement and liquidity is the functional cherry on top that helps solidify the deal and make sure that everything goes successfully. But really bringing that home with all the other services and angles that we aim to help make you successful through.
I'll try to keep mine short. We're probably running on time. But when it comes to terms, I would say that, market makers in general, especially after last cycle, are perceived by the market as predatory and operating, in a very opaque manner. And I think this cycle is the opportunity where we need to step up and change that perception. And so if I'm a project, what I would set a hard boundary on is having access to real-time KPIs on the liquidity provision, regardless of what financial arrangement I put in place with my market maker. If they're not willing to be transparent with me, I would not be willing to work with them, period. The second question that I would ask is, how are they structuring the opening order book, and how does that translate to the contract structure that they're putting together with you? And the reason for that is the primary listing is the birth or the crypto IPO equivalent. It's the most important day that's etched in stone for these projects. And a lot of the terms of these market-making contracts do not reconcile with providing sufficient liquidity on market open to enable efficient price discovery for the asset. And that hurts the community, which hurts the project itself. So those are two things that I would really want to understand.
So I was told we have time for one last question, actually, and this is for all the founders in the audience. Put yourself in a project's shoes. What are the questions that they should ask you, but they never ask?
I think that projects oftentimes, when they are looking at the loan and option model, depending on the founder's background, they may or may not really understand what that means or how to price an option. The other set of questions that I think projects don't necessarily ask, which they should, is about what are they really getting? What is market making? What does our infrastructure look like? What is our tick to trade? What's the uptime on our own systems, right? I think they perhaps they don't fully understand what the technology stack is that it takes to deliver market making, which is perfectly understandable because it's not their business and it's pretty complex. But I really do love explaining that to projects, and so that's something that I wish they would ask about more.
Yeah, I would say what does success actually look like? It's not just token price go up. It's liquidity, KPIs, the network that we can bring, all these other aspects of it. And if your token price, like I said, just it doesn't need to go up to the right consistently. Build your project, solve problems, and we'll be here to provide liquidity, and we'll show you that we can.
I guess in my view, I think will be interesting to ask is just be transparently asking how market makers are incentivized, because we actually, I think at least for all of us here, we don't mind transparency. But a lot of times when a token price does not perform, they always blame the market makers, thinking that we dumped a token, which we didn't. So if we can have an upfront discussion about how market makers are incentivized, how we actually manage inventory, what's the probability looking like for us, you'll see that the scenario is actually the opposite, right? It's how we hedge the option, how we price that, et cetera, et cetera. So then I think if we're able to have that honest upfront discussion upfront, then maybe we can avoid a lot of misunderstanding later.
Yeah, so I was actually going to say the same thing as how do market makers make money? How do you make money? And, to answer that question, and Julia alluded to it earlier and Annabelle just touched on it briefly, but it's really by hedging the optionality on the structure and not by, doing any predatory prop trading, by overselling your token. The position that you have with a loan and optionality is what's called a long gamma position, which means you're incentivized to sell high and buy low, and you're incentivized to do that multiple times a day and in the long run. And by collecting those small spreads over time, it allows you to have a profitable trading experience as the token price trends higher. And to a certain extent, what also Julia mentioned earlier is like people are concerned that market makers are going to dump at the end of the contract, which is actually not true, because every single day you're providing offers with the tokens that are loaned to you. You're not providing taker liquidity, you're providing maker liquidity. You're making the offer, and as that offer is lifted, let's say your loan was at 100% to start, it goes to 80%. Towards the end of the contract, if the option's in the money, it goes to 20%. So actually, when the contract expires, you may only have 10% of the tokens left. And that's not something that you're going to dump into the market. Oftentimes contracts are rolled. And, if market makers were dumping those at the end of contracts, that would be something that people talked about quite a lot more. And, I rarely ever hear that. So it's kind of from my angle.
Yeah, they're typically, buying them back at the end of the contract to close their short position. But, how do you make money is a really great question founders should ask. They should also ask, what price curve or how much inventory is needed and why that quantity of inventory is required, given the KPIs the market maker is going to be quoting. And then what price curve will that market maker be able to quote those level of KPIs through? That's on the upside and the downside. It's really nice to see, big numbers in terms of KPIs, but what does that mean in terms of uptime and price curve? So these are the type of questions that I would ask if I was a founder, on top of the transparency, which, would be just a hard block for me.
Awesome. Well, thanks everyone for the panel here.